Okay. All right. Amazing. I'm Sarah Larby. I'm here with Harry James. I'm going to give Harry an introduction and Dalia Barsoom. This is about the topic I think is very important. It's very timely. Investing and managing your portfolio for market downturns, turbulent times, and Harry wanted me to add this, unpleasant surprises. And we are really going to be ensuring that we have staying power. Here's the thing right now. We all know what's happening in terms of rates increasing very quickly. They're probably going to increase some more. We know the government is really trying to step in with some new regulations and make investing more and more difficult for us. And we also know that there's market cycles, right? I mean, all of us that have been investing, for 5 years, 10 years, we all look like geniuses at this point, right? Because the market has done so well in the majority of, of the markets and the majority of strategies. But, we've all done really, really well. And it is important to understand that, like, even though things have been amazing for the last 10 plus years, at some point the market is going to shift. How much, how bad, we don't know, but it's a circular cycle, right? And this has been a very, very long market cycle. And the tides are really starting to turn. So we've got to make sure, and today's topic and conversation is going to be about ensuring that we have staying power, that we are investing for the long haul, and we are not going to be pushed to the side during, in my opinion, the next few years of very uncertain, probably turbulent time. So we need to plan for all these eventualities. We need to have staying power. We need to have contingency plans. And we need to ensure that we're going against the crowd, as well as having cash and opportunity to be able to invest as more and more opportunities will likely come up. And also Dalia is going to be talking about getting our financing in order and what we need to do. So it is important to have that staying power. It is important to be able to be an investor in times like these and not a speculator. I'm just going to mute you, and there we go. Just because there's some background noise, Harry, I'm just going to mute you for a second.
I thought that was my computer. I thought that was my computer. I kept lifting it up, checking the fan.
No, that's okay. I think it's in Harry's background, but I'm just going to continue just a couple things. So what we're going to do today is Harry is going to speak first. Feel free to, ask some questions in the chat. This is, obviously there's a lot of people on here, but we also want to make it as interactive as possible. And so Harry is going to present for, 25 to 30 minutes. He's been around, he's my mentor, but he's been around investing for the last 30 plus years, has gone through many different market cycles, ups and downs. And he will tell you this is an exciting time for him because there's more opportunity than there might have been in the past. So we're going to hear from Harry first, and then we're going to hear from Dalia. Dalia has some great strategies that her and I have talked about recently about how to mitigate your portfolio, how to look at your financing, and to get that in order. Because right now we know something's going to happen. It's just going to be a matter of how soon, how deep. And we want to be investors. We don't want to be speculators. So Dalia will also talk about, likely for about 25 to 30 plus minutes. So altogether, we should be done just a little bit after 1. And so Harry's had, any type of real estate strategy under his belt. He is the one teaching me developments. We've got the resort that we're doing together, many other great projects. And, Harry has been through the ups and through the downs. And so Harry, feel free to unmute yourself and share, with the audience here, what we should be aware of and how to ensure that we have that staying power.
Thank you so much, Sarah. I apologize. I'm in the Live Real factory. I didn't realize that you'd be picking up that sound as much as you are.
All good, all good.
Is it really annoying? Do I need to move?
I think we're okay. Maybe just get a little bit closer to the computer, and then your voice might be a little bit.
Sure. Yeah. I can be loud and obnoxious, no problem. First of all, I want to say, anytime I have the privilege of speaking to anybody about real estate or businesses, I always like to preface it by saying it's just my personal experience. I don't hold myself out as an expert. I'm not out there telling everybody what to do. This is just pure, crude, going through the motions, failing miserably, learning as I go, asking tons of questions, putting my pride on the shelf. My gray hairs and the lines on my face have all been earned through this. I think my kids helped add a few as well, but I just want to give you my perspective on how I'm looking at what's happening right now. And maybe through my perspective and my lens, it might give some of you some comfort or some ideas or just a different way to kind of approach what period we're going through now. And I think the first thing is, I always like to say is, only cross the bridge you're in front of. There's a lot of speculation that we're going to have a huge correction, a huge downturn, but maybe it's not going to happen. So you kind of hope for the best and plan for the worst. I wouldn't be losing any sleep over things that may or may not happen. And I think that's one of the things that's happened to all of us through COVID is we get too glued to social media, too glued to the news, too glued to all of the doom and gloom. It's like you can't turn away from the accident scene. It's not a healthy place to be. And I think it's really, really important. And I always like to talk about this in anything in life. It all comes down to your mindset. And you have to protect your mindset. You have to have guardrails and you have to put things in perspective. And I think when you do that, you're going to find, even if we do go through some very choppy waters, it's not going to be as bad as you think it's going to be. It's not going to be as horrible as you think it's going to be. As long as you're in it for the right reasons, you know what you're heading, and you have a set of criteria that you can gravitate. So it's kind of the macro and the micro. If your macro, if your vision for real estate and what you want it to do for your life is sound, well thought out, you're living your definition of success, you're not trying to emulate or copy anybody else, but you've thought it through for you, then the key to real estate is always to persevere over the long haul. It is never a short-term game. You don't get rich in real estate short-term. You get rich in real estate persevering over the long haul and navigating the ups and the downs. And I think that's true for businesses and a lot of other things in life as well. So I think it's critically important that as you go through this phase, whatever it might throw at you, stay focused on the end game. Stay focused on why you got into it in the first place. You know, I couldn't agree with Sarah more in terms of her comments, and I don't want to hurt anybody's feeling, but the reality is, in a strong wind, even turkeys fly. You did not have to be brilliant to make money in real estate over the last 10 years. You just needed to jump on the bandwagon. And if you did, that's awesome. But it is time to step back, however, and say, okay, if it is not all champagne and ribbon cuttings, and there's going to be some pain, am I ready for the pain? Do I have a contingency plan? Do I have resources? Do I have the creativity? Do I have the contacts? Do I have a Dahlia in my life that can help me navigate? Because I'll tell you right now, I've never, seen lending be more difficult than it is today. We thankfully we qualify for conventional financing, but in this market, in this environment, banks work for their shareholders. They're not working for you. And when you have somebody that knows how to navigate the banks, knows how to negotiate, knows how to present a deal, because everything in life comes down to really selling and making a strong case, you want to make sure you have the proper people around you to do that. So let me give you an analogy that helps Harry James sleep. Let me give you an analogy that helps me put everything in perspective and really not get too bent out of shape about what may or may not be happening. And by the way, I'm going to share some personal stuff with you today, but we have been hurt. We've been hurt by COVID. We've been hurt by high interest rates. And we've been hurt by a couple of things that COVID has brought on in terms of increasing expenses. So I'll share those with you in a moment. But here's what I want you to do. I want you to all come with me, all 200 of you, and let's go for a roller coaster ride. Personally, I hate roller coasters, but we're going to go on a ride anyways. So all 200 of us are going to go. And this roller coaster ride is 4 minutes long. It's the biggest roller coaster in the whole world. It freaks a lot of people out. It's got loops. It's got death-defying drops. It's an amazing roller coaster ride. So we're all going to get on and we're all going to strap in, all 200 of us. Now through this ride, you're going to get all sorts of feelings: elation, fear, trepidation, exhilaration, all sorts of emotions you're going to go through. But here's what I think for most of the 200 of you, what you're not going to do. When we're going down a hill at 100 miles an hour, most of you are not going to take off your seatbelt and hurl yourself to the ground. That would be a very bad decision. Obviously, you wouldn't be getting off the ride safely. No, you just hang on because it's going to get better. And sure enough, at the end of it, you get off safely. Through the roller coaster rides, the ups, the downs, the twists, the turns, the screaming, the tears, all of it, if you stay on, you get off safely at the end. 100-year track record of that. So I'm going to take my 4-minute roller coaster ride and compare that to my journey in real estate, which, believe it or not, is almost 40 years. And that's where you all pause and say, you know, he doesn't really look that old, but honest, almost 40 years of that roller coaster ride, ups and downs, fear, trepidation, some tears. But you know, I can promise you that after the 40 years, by sticking to the fundamentals, staying in the game for the right reasons, focusing on the big picture, thankfully for us, each and every time we've gotten off the ride safely. I do recall, however, 1989, 1990, when we were in a period similar to today, there was a significant drop in real estate, I believe from 89 to 93, about a 20% drop, but there were some anomalies where it was a lot worse than that. I just saw the other day a Stouffville townhome that sold for $1.25 million in February, $1.25 million. The same unit just sold yesterday for $780,000 or $800,000. Now that's a $450,000 hit for whoever bought that in February. That's that can be a little tough to take. That can be a little tough to take. But in those periods, people that panic, that throw themselves off the roller coaster, lock in losses. You see that person, even if they paid $1.25 million for that townhome, and we have a major correction that brings it down to 800, if they stay the course, if they just put it on their net worth statement as if it's still worth 1.25 million, you're only locking in losses if you sell or if you panic. And here's another, if I could take that townhome example, I'm sitting in the old town hall, and in the late 80s, early 90s, I picked up my phone and I bought a building just down the street because I needed parking for the old town hall. Now, the building I put an offer in on, the gentleman that owned it turned down $800,000. I made an offer for $350,000 for that building, and we actually did a deal at $350,000. Now, he turned down $8. It went down to $350,000, but that same building today is now $2.5 to $2.8 million. The roller coaster, up, down, interest rates, wars, recessions, always something going on. As long as you're in the game, there's going to be negatives, positives, ups, downs. But if you're focused on the macro, if you're focused on the long game, if you're in it for the right reasons, in this environment that we're about to navigate through now, we don't know how bad it may or may not get. But if your macro is set, you can do the little adjustments on the micro. And what do I mean by that? Well, we went out on a little road trip yesterday to check out some of our portfolio. And Dahlia and Sarah will know that we did a project in Lakefield called Red Brick Lofts. It was a 4.5-year project, over a $5 million investment. We've created 14 luxury rental apartments. And thankfully, we're basically at 100% occupancy now, and it's just coming up on 5 years. And we were out doing we call our tenants clients. We want them to stay. We want them to be happy. And by the way, this is just a little side commercial. You can't run your real estate portfolio from behind your computer screen. Don't do that. You've got to go out physically on the road. You've got to see your tenants with your own eyes. You've got to see what's happening with the building, with the paint, with the parking lot, with the maintenance. If you try to do that from behind a computer, you're going to find yourself in trouble. You've got to physically walk through your properties on a regular basis. If you don't do that, again, you'll find yourself in trouble. But we met with our snow guy. Now, anybody that has real estate and anybody that needs to have snow removed, especially for commercial and liability reasons, has been absolutely slaughtered this year. I think some of our contracts were up 200-300%. Well, I have my snow guy for Red Brick Lofts, and it's a tremendous amount of snow, telling me that he has to double his prices. That doubled from the year before. He also told me because of COVID, he has to double his prices for cutting the grass and maintaining the property. Now, Dahlia will love this. What also happened at Red Brick after almost 5 years is because of COVID, the Bank of Montreal that holds our conventional first mortgage, and it's a relatively small mortgage compared to the value of the property. When I was negotiating with the Bank of Montreal and they told me I was going to have that mortgage last September, October, it's actually just closing this week. So instead of 3%, it's 4.79%. And instead of a $40,000 or $50,000 positive cash flow that I was anticipating. We're basically lost all that because the Bank of Montreal decided that because of COVID, they could be understaffed and they could not return our phone calls and not get the appraisal done on time. And it's the small entrepreneurs like you and I that have to own all that downside. So on that one little stop yesterday, I probably was exposed to about $60,000 to $80,000 of reality sinking in that has kind of blown up on a micro basis, has blown up my little spreadsheet that looked a lot prettier back in October. I'm sure a lot of you are like that as well. But what do you do? That's where the creativity and the contingency plans come in. Are there other areas where we can create income? Can we rent out some of the property? Can we add more units? Can we be more efficient and proficient with our water purification system? Should I hire a superintendent to plow and to cut? Would that save me some dollars? So these are the discussions I'm in now with my partners is how do we turn this into a situation where we can improve some of these negative surprises that have come upon us as a result of rising interest rates and COVID. Now, the thing with COVID too, let's be candid, some of the excuses are real and have substance. Most of them, in my opinion, are just an opportunity to rip people off. Like I'm not sure I understand why some of the prices are up 200, 300, 400% when I go to Home Depot where we deal in Coburg and there's enough lumber on the yard there to last for 10 years, but somehow we have to pay $10 a 2x4 instead of 3. But that's again another side discussion I guess we could have. When I'm going through these things, and I mentioned this at a gig I was at with Sarah the other day, what am I mindful of? What do you have to be mindful of? It's the game that we're playing. That's what it is. It's the roller coaster ride. But none of these things that I'm dealing with in my real estate journey, whether it be increasing costs, increasing interest rates, COVID ripoffs, none of those things detract from the things that matter most in my life. And that's why I want to take you back to mindset, attitude, perspective, what's important to me. You see, that deal at Red Brick yesterday had nothing to do with my 4 healthy children, my 4 healthy grandchildren, and the fact that thankfully I'm still happily married and we're planning some trips. It didn't stop me from getting in my gym and working out. It didn't stop me from eating well. It didn't stop me from reading and feeding my mind with positive things and making sure that I edited out or protected myself or had a filter for the things that are incredibly destructive. So when you're going through turbulent times or times where they're stressful, what matters the most, frankly, is the person in the mirror. How are you prepared mentally, physically, spiritually, and financially for navigating a storm? And that's why you have to go back to one of the questions I asked a moment ago is, why are you in the game? What is it you're trying to achieve? Are you doing it for the right reasons? Are you living your definition of success? Have you stretched yourself a little bit too much? Should you be looking at contingency plans, partners, or whatever the case may be to make sure that if things get a little bad, you can ride through, or when you see a great opportunity, you can maximize that opportunity. You can take that opportunity and jump in, because I'll tell you, when you study history, the greatest wealth on this planet has happened when you have the intestinal fortitude to jump in at the highest degree of pessimism. I want to repeat that. Some of the greatest wealth on this planet has happened when you have the intestinal fortitude to jump in at the highest degree of pessimism. So if somebody, and I don't look forward to taking advantage of anybody that's in a bad situation, but the reality is, in markets where things get bad, where $1.2 million townhomes has become 800,000, human nature tends to be panic. The world is coming to an end. It's never going to come back. I'm going to go bankrupt. My life is over. Whatever the case may be, if people are not filtering, listening to all the bad news, reading all the reports that probably don't even relate to what their situation is, but again, they get in your psyche. If you're doing that, there's going to be opportunities that are going to present themselves. Are you going to have the conviction? Are you going to have the belief? Are you going to have the vision to go against the crowd, to jump in? Because here's a confession. I haven't bought in the main laneway for 5 years. I've never done a multiple offer. In the last 5 years, we created our own product and sold it. And in the highest degree of pessimism, in the last 24 months, we bought 2 commercial properties when everybody was saying that retail is dead, it's never coming back, online shopping is the way it's going to be forever, and human beings don't need to interact anymore. We can just wave at each other on computer screens. Now, I didn't buy into that. I didn't buy into that for a moment. So we found a property that was listed for 4.2 million that eventually went down, 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 and we picked it up for 2.1 million. And today, that same property, less than 6 months later, is fully leased with a cap rate that makes it worth almost $4 million. And that's not any fabrication. That's no brilliance on my part. That was just believing that the world wasn't coming to an end, believing the people that I know still want to go into retail shops, believing that the entrepreneurial spirit and people's dreams of building their own business was still alive and well and wasn't going to be wiped out by COVID. By believing that, I jumped in at the highest degree of pessimism. And on that particular property, for our team, we created $2 million of additional equity in our company. Then we repeated the process. The exact same thing happened on Main Street in Cobourg. And by the way, folks, if you want to have a look at these things, it's 141 Main Street North and McCallum Block. They're on the Harry James Enterprises website if you actually want to see the buildings. But the reality is the same thing happened in Cobourg. And Dahlia would know this. One of the reasons we got Cobourg is because the person that was trying to buy it could not get a commercial mortgage to save his life because all 4 retail places were shut down. The place upstairs was shut down, and it was a very, very difficult property to finance. So we were able to put, as a result of our track record, some funds together, and we also bought that property. Again, another nice $2 million lift. And by the way, you know what was nice about those 2 deals? And this is, again, this is not to be bragging, because I could spend the next 3 hours talking about my failures and my mistakes. So please don't think I'm bragging about this. But what was nice about those 2 deals is it wasn't crowded. There was no multiple offers. We were going against the crowd. We were salmon swimming upstream. And in a very, very difficult, ugly market, we put some very nice net worth on our shareholders' bottom lines. That's what I'm talking about, having that belief and that conviction and being prepared to capitalize. And if you folks will get prepared to capitalize on what may be coming, mentally prepared, get excited, have a vision. As Gretzky would say, where's the puck maybe going to go? I love soft underbelly stuff. Where's everybody else not going? Where can I go that other people will be fearful to go or have difficulty going? Because again, like go back to the roller coaster ride, for 40 years, I've gotten off safely. Now, there would have been times if I panicked or reacted, I wouldn't. I'd be in the hospital with 4 broken limbs, maybe worse. But when you persevere, you have a plan, you have an end game. This is the best market in the world to be in. Who in the world wants to be at a table with 35 other offers? My goodness, that's not investing, that's speculating, that's gambling. If you're a serious, real estate investor now, a serious real estate investor now is going to have a field day because it's going to be a calm market. There's going to be lots and lots of opportunities. There's going to be actual due diligence you can do on deals without feeling you have to panic and buy in 15 seconds because you're going to lose the deal. There's going to be many people, and this isn't just true of real estate, by the way, but we all know there are people that panic and they go on what you call bandwagons. So the people that have been on the bandwagon in real estate, they're going to be thinned out. It's like all the real estate agents in the 80s and 90s that got into the real estate business because it was so easy to make money. The minute correction game came, about three quarters of those real estate agents went back and did something else instead of selling real estate. Well, the same thing's going to happen as investors. You know, when you can't just ride the wave, when you can't just cash the checks and sip the champagne, and you actually have to deal with problems, tenants, problem financing, challenges with your partners, challenges with the bank. When you're dealing with those things and you're fighting through, now you're in business. Now you're learning. Now you're sharpening your skill set. Now you're sharpening your toolkit. And as you do that, you're going to be more keenly aware of how maybe you can ride the elevator up 5, 10 floors in one fell swoop. That's what the type of market that might be coming might provide for all of us that are on the line today. So being mentally prepared, having the mindset, putting things in perspective, recognizing that it's just a game. I always say this, and I don't mean it to depress people, but folks, we're all going to die. It's one death per lifetime per individual. We got to go over it. We don't want to waste our time with fluff and stuff. But if you're playing the game, let's have some fun. Let's play to win. And if you're taking care of your health and your relationships and you got a good foundation, you don't have to be sitting with truckloads of money. You don't have to have tons of knowledge. You just have to humble yourself and ask tons of questions. There's so many people in this game that want to help you. There's so many people that have been through it. There's so many people that can share. I mean, one of the things I love sharing is the mistakes that I've made, because I've made a truckload of them. And if I can share those mistakes, you can maybe avoid them, or at least take those mistakes and not have them, not suffer as much from them, maybe the way that we have in our journey. So this is going to be a beautiful time. Even right now, as I'm listening to the sentiment, there's a lot of people that are really, really cooling their jets. That excites me, because that means that we can use logic and we can do some due diligence and some analysis and really take a look at where you want to take your portfolio. And I really want to challenge you on this. And I ask you, why are you in the game? What is your end game? What are you trying to achieve? Is it lifestyle? Is it to help people? Make sure you're connected to that, because that's what's going to give you the conviction. You know, desire without discipline leads to depression. If you have a desire to build your portfolio, you need to know why. That's what gives you the discipline to execute. That's what gives you the discipline to jump in there and to make things happen. So take this period to really step back and recognize you're in business. This isn't about transactions. This isn't about buying low and selling high. This is about building a business that is reflective of what you want for you and your family. And I'm telling you, the opportunities are going to be tremendous, but you'll miss them if you aren't ready. You'll miss them if you're not mentally prepared. You'll miss them if you aren't in the game for the right reasons. You'll miss them if, by the way, you spend way too much time reading crap, listening to the news, and really, there's so many people out there that want to make a name for themselves by scaring the hell out of everybody. 90% of the stuff of what they say probably is not even relevant to you or your portfolio. Only focus on your backyard. What's germane to your situation. Try your best to insulate yourself. Like interest rate hikes, yes, but maybe your portfolio is not going to be hit that hard because of the way that you staggered your renewal rates. Maybe you have contingencies in there for an extra unit that could easily offset an interest rate hike. Maybe there's some rents that need to be propped up. Maybe you can buy one of your tenants out and re-rent at a more market rate. Like that's when you're getting into the micro of actually running your business. But if you stay in the fear lane of interest rates are going up, the market's going to go down. I read the other day, somebody said it's going to go down 45, 50%. It's showboating. How in the world do they know? They don't have a clue. And it's not always stagnant across the board. Every deal, every property is completely different. You've got to look at it in the context of where you've been, where you are, and where you truly want to go. So again, mindset, be careful. Focus on your mindset. Make sure you understand that you put things in perspective. It's just a game, but play to win. Know your craft and surround yourself with great people. Know why you're in the game. Know what the end result is you're after. We've been at this, as I said, almost 40 years now, and I plan, God willing, to be at another 30. So I'm not planning on going anywhere unless I get hit by a milk truck. But the point is, I'm always fine-tuning my vision, my philosophy. I'm always looking. Right now, I'm looking at the portfolio. Where can I insulate myself? Where can I improve? Where can I get my costs down? How can I deepen my relationship with our clients and make sure they're happy? How can I give them an extra joyful experience so they'll stay with us when they renew their leases? We're running a business. We've got to look at it from that perspective and focus on the things that we can control and only cross the bridges that we're in front of. That way I can sleep at night, I can get up in the morning, and with the right mindset, play the game to win.
Amazing. Awesome. Lots of great information. I mean, I've taken a few notes down too, and I think it's going to be, like you said, a great opportunity for the savvy investors to be able to create a lot more wealth than in these markets with 20 and 30 offers. And, this is also an opportunity to mention, and I've mentioned it so many times on my podcast, have some cash flow, because if you can cash flow these properties, if you can cash flow these deals, rather than just banking on appreciation, you're going to be able to stay on that roller coaster that Harry was describing and not actually realize a loss by panicking. And you mentioned, be greedy when others are fearful and fearful when others are greedy. I think this is a great opportunity, to have that staying power. And just looking back at like 2008, 2009, there's a lot of people that lost their shirts. And on the other side of it, there's a lot of people that took the opportunity and that have created massive, massive amounts of wealth by being very focused, looking at opportunities, going against the grain, different sandboxes. I mean, obviously you've been doing well in not necessarily the typical cookie cutter types of deals, but just really being able to create something different. So super awesome. And guys, just for those of you that may not be aware, Harry and I are creating little workshops that we're going to be talking about mindset and all of that good stuff. So stay tuned. We will give you some more information on that. And Harry, thank you. Great conversation, great discussion. We'll have you come back at the end if there's any Q&As. But again, it's good to learn from those who have gone through the market cycles, who have gone through the ups and downs, and have been able to get to the other side. And again, it's going to be interesting. I don't think it's going to be super easy. I think there's going to be lots of challenges, but you have to have the right team in place as well to be able to mitigate and overcome those challenges. And a big part of my team member, or my expert team members, obviously Harry being my mentor, and Dalia Barsoom from Streetwise Mortgages has helped me, I think, since 2015 through all of my acquisitions and understanding my portfolio. Dalia and her team are investors. They work with investors. And, I really wanted Dalia to really talk about, what we're seeing in the markets from a financing point of view, what you can do from your portfolio to be able to actually, mitigate the potential negative cash flow and ensure that you're still able to take the rate increases and all that stuff. And I think there's some really cool strategies that many of us may not know about. So Dalia, welcome. I don't know if you want to present or not, but I'm going to make you co-host if there's anything that you want to share. But feel free to take it away.
Excellent. Folks, I'm going to cover all of the geeky stuff in my presentation. It's not as fun as Harry's, but so it's all geeky, but it's going to be good for you. So let's get started. Just want to make sure you can see my screen.
Yeah, we can see it. You're good.
Yeah? Okay. All right. Okay, folks. So as Sarah mentioned, we are a boutique mortgage brokerage, and we work primarily with real estate investors. And we've helped thousands of investors, not just only scale, but also plan during different market conditions. During COVID, where there was panic, there was fear, there was an anxiety, we had a lot of investors call us for guidance on what to do. And like Harry said, it's about planning and insulating, and also choosing what to listen to and not what to listen to, because there is so much noise out there. And my objective for today is to extrapolate what I believe is important for investors and help you understand how it impacts you. But not only that, how can you hedge? How can you plan? Because as Harry and Sarah mentioned, it's about what we can control, okay? That's what we can work with. So let's get started. As we all know, again, a geeky chart here about inflation. It's all over the news right now. It's in the spotlight, and in our day-to-day living, we're experiencing it. So as we know, Canada's annual inflation rate has accelerated faster than expected in March. Right now, we're sitting around 6.something%. Bank of Canada typically wants to see inflation in the 2% range, and it's way above where it needs to be. And therefore, all of the talk about the rate hikes and the accelerated rate increases. So with all of this in the picture and the bank's attempts to manage inflation, there is an expectation, of course, that the rate hikes will continue to take effect. The next Bank of Canada meeting is in June, and there will likely be a rate increase at that point as well. here's the thing, there is, and Sarah and Harry, jump in if you have views on this, but the question is whether this inflation is going to stick with us for the long term. But many believe that it is temporary pressure that we're dealing with, and once the bank has control over inflation, eventually they will go back to the normal rate policy. So it is a temporary accelerated effort to control inflation. But by 2024, we should see, and again, I don't have the crystal ball, but again, the indicators, the research, what happened in the past shows that the bank puts the brakes on inflation through the rates policy, through the monetary policy, and once that's in control, they can ease up their measures. There is always a risk, of course, of recession if it's too aggressive, but nobody really knows if there is going to be a recession or not, although there is talk about it right now. So here is what's happening on the rates front as a result. So this is the chart of the Bank of Canada overnight interest rate, and it is really the rate on which variable rates are based. So every time the Bank of Canada increases its overnight rate, that impacts the bank's prime rates that is used to price your lines of credits, your unsecured loans, your variable rate mortgages. So right now, if you look at the chart in 2020, before 2020, we were at an overnight rate of 1.75. And when COVID hit, the bank dropped that overnight rate to avoid a recession and to stimulate the economy down to a very low point at 0.25. And therefore, since COVID, we've seen incredibly low interest rates. We got so spoiled by these interest rates. And now the bank is saying, okay, inflation is a concern. We want to come back to where our target rate used to be. So what we're going to see for the remainder of 2022 is a continued effort by the Bank of Canada to bring what's called their overnight rate from the low point back to not the 1.75. Right now, the expectations is that they're going to try to get it to 2 or 2.5%. So right now, their overnight rate based on the last increase was 1%, which pushed the bank's prime rate to 3.2. And the next Bank of Canada meeting or announcement, interest rate announcement, is in June. There is an expectation that the rates will rise by another 50 points, and in July by another 50 points. So overall, the expectation is that there is going to be another 1% increase by the end of 2022. How fast or slow they're going to go about it is a question of how aggressive they're going to get. Every time they raise the rates, they look at what impact it resulted in, and they have to either push the gas or pull off the gas. So the pace of these increases is speculative, but right now it looks like in June they're going to raise by another 0.5 point, and by end of 2022, they are going to raise in total by about 1%. There is also continued expectations that in 2023, they will raise by another 75 points. So here's the thing. For every 50 points increase in prime, okay, if you're on a variable rate mortgage where your payment changes as prime changes, and not all of us are, some variable rates are capped. When the interest rate changes, some variable rate payments stay fixed, but the allocation of what goes to principal versus interest changes beneath the surface. So if rates go up, more goes towards interest, less goes towards principal. But if you're in a variable rate product where your payment changes when the interest rate changes, for every 50 points increase, okay, there is about $30 increase on $100,000 for every $100,000 of mortgage on a 30-year amortization, okay? So direction of rates is variable rates will rise in 2022, in 2023. By how much? It looks like There is another 1% coming in 2022. How fast is not clear, but likely half a point in June at least. And then in 2023, there is going to be another increase. And then that should bring the bank's target overnight rate to where the bank wants it to be, to slow things down from an inflationary standpoint.
Yeah, I'm just going to jump in real quick before you get to the next slide, but I think it is interesting that there are options even with variable that you could just pay less principal and more interest if somebody really truly needed to go that route. So that's an option, right? How easy is it to switch over to something like that?
Well, qualification is the same. It's just requesting a particular product with the lender, and some lenders do not offer it. So we just need to see if you qualify with the lenders who do.
Okay, perfect. And I know there's some questions, but we'll probably take those till the end. We'll let you continue.
Okay. On the fixed rates front, folks, fixed rates are priced based on the Government of Canada bond yield. I'm not going to get into the technicality of what the bond yields are, but essentially, whether it's the Bank of Canada overnight rate or Government of Canada bond yields, this is the cost of money for the banks. So when these two change, Bank of Canada's announcements affect variable rates. The bond yields affect fixed rates. So if you look at this chart, bond yields have jumped. The pricing of bond yields have jumped quite a bit from March to where it is today at 2.6. And this is why the cost of money to the banks have also increased, which impacts their fixed rate mortgages. And this is why you may have seen the fixed rates go up. Right now, the gap between fixed and variable rates is about 160 to 170 points. In the past, historically, if you wanted to switch from variable to fixed, you would pay a little bit more to switch. Right now, you have to pay a lot more to switch. But as variable rates continue to climb up, that gap will diminish. So fixed rates are also going to go up. Prime rate is going up. Now, here's the thing. Here's the question that we are getting now all the time, okay? The question is, do I go with a variable or a fixed rate? And here is what I can tell you. As I mentioned earlier, the gap between variable and fixed is big. So if at this point in time, today, if you want to make a decision as to whether or not to lock in, okay, the gap is large. So I believe that there is quite a bit of a runway for variable to climb. As I mentioned, there is about a 1% increase coming in 2022 with another 50 to 75 points in 2023. So there is quite a bit of gap for variable to catch up to where fixed rates are right now. And we know that fixed rates are increasing. So I recommend that you stay with variable. And I'm going to add an asterisk next to this statement because everyone is different. I can sit here and say, do this or do that, but at the end of the day, every client is different. You may not sleep at night when these rate announcements come in, although on paper, we can show you that you're better off sticking with variable, but you may panic. So then whatever I'm going to say is irrelevant. So from a mortgage standpoint, the gap is large. I believe there is enough room for variable rates to ride. And I suggest that you stick with variable because there will come a point in once they have a control over inflation where they're going to ease up the monetary policy and interest rates should go back to normal state. They're not going to go back, in my view, to 2020 rates because that was the floor, but we should see them, you know, pre-pandemic, I would say. Now, despite all of these rate changes, put things in perspective. Rates are still low. Cost of money is still low. We're not talking here about private rate mortgages. We just got very, very spoiled seeing rates at 1 point something and now a 3 point something or 2 point something is sounding like, oh my God. the rate is much higher. It's all relative, but the cost of money is still attractive in my view, okay? One of the things I highly suggest as an investor that you do right now, given that we're heading into a changing rate environment, is to stress test your portfolio. So instead of sitting here saying, oh, should I go variable? Should I go fixed? Oh, but historically variable shows that it's a better option. And Dalia said that there is a gap and there is enough to ride the wave and the rates eventually will ease. I invite you to stress test your portfolio. What does that mean? We have a calculator that we share with all of our clients. It's complimentary. What I would do is I would take every property that you have in your portfolio and basically look at the impact of rate increase. So there is likely a 50 points increase in June. There is likely another one in July. And then in early 2023, there is a 75 basis points. So that's really what the economists are talking about. And to tell you the truth, economists have missed the point. Economists are not the Bible, okay? But I'm just going by the best gauge of what may happen at this point and plan around it. It's not set in stone. So every property that you have, you plug into the calculator. You may have taken a variable rate mortgage when the discounts were amazing several months ago at prime minus 70 or prime minus 1. So you would have even a longer runway before, you know, variable catches to where fixed is, and you should be fine. But if you're at prime minus, you know, a smaller discount and you're debating whether or not to lock in, I would take the property, run it through the calculator, and then see how it impacts my cash flow and how it impacts my savings. Again, depending on your individual situation, you may be fine with a slight increase in the payment, or you may be fine, given that your payment doesn't change. I don't know. I'm just saying, go through the stress test. Let's look at every property, determine if you're okay with how things will look or not. If you're not okay, then let's talk about opportunities to hedge. And how do we hedge in an environment like this? Well, there are multiple ways other than locking into a fixed rate. One way is to say, okay, my payment is going to increase. I can't stomach that. Instead of locking into a fixed rate, what can we do? We can maybe look at re-amortizing certain loans. Yes, it's going to take you longer to pay off that mortgage, but it does give you now a little bit of breathing room because it brings your mortgage payment down by stretching the amortization. That is one way. Maybe we pay some expensive debts that you have with some cheaper debts. Car loan that is costing you a big monthly payment that we can maybe clear out of your budget by using cheaper money. Now you got rid of a $1,200 monthly payment. So if things increase by 15, I don't know, $500, it's not a big deal because we've cleared room to absorb an increase somewhere else, is my point. There is also an option for interest-only loans. We can convert a portion of a mortgage into a secured line of credit temporarily. This way, you reduce the payment. Yes, you're paying interest-only payment, but you're reducing the payment. Again, if you're concerned about pressure, financial pressure on your cash flow, we can use techniques like that to help you maneuver and be ahead of this curve. Other than just let's lock in. And by locking in today, just to give you an idea, a fixed rate on a rental is around 4%. A variable rate on a rental is around 2.8%. Big gap. So if you lock in today, you're going to force not your loss, but you're going to force an increase in payment for the next 5 years. And if in 2 years from now, the rates change, then you would have locked in at the highest point, in my view, and you can't exit that mortgage. But if you can ride this wave through variable rate, okay, by planning strategically, you will be okay, in my view, okay? So I just wanted to bring that one to your attention because that's a big topic right now. Okay, so here's also something else that you may not have thought about that will be impacted as a result of the rate changes. As we know, mortgage qualification is dependent on something called the stress test. Back in 2018, folks, the banks changed the rules on how they qualify mortgages. So when you apply for a mortgage, they look at the rate they're giving you, add 2% to it, and they compare it to what the bank qualification rate is, which is 5.25. Whichever is higher is going to determine how they're going to work your application. So right now, the qualification benchmark is 5.24. As variable rates rise, if you're taking a fixed rate and they're adding a 2% to it, they're now qualifying your application at a benchmark or a standard higher than where things are right now, which translates into lower money for you. But let's assume that you're going to stick with a variable rate. As variable rates rise, that bar continues to rise, the qualification bar continues to rise. I don't think it's going to hit the 525 that we are right now with the bank. So I'm not concerned there. But where I see a concern is with B lenders. So lane one is your A lenders, the banks. Lane two is your B lenders. These are the lenders who charge a higher interest rate when your application does not work with a bank. Lane three is private money. So if you are with a B lender or you are on the edge of qualifying with an A lender, as the rates rise, it's going to raise the qualification bar with these lenders, translating into lower money. So you want to take out equity, it would result in taking out less money. You want to qualify for this much purchase, it may be less mortgage. So what can you do about it? All I'm saying is recognizing that this will get tougher as the mortgage rates rise. We want to be ahead of the curve. So if you have plans to buy properties, if you have plans to take out money, let's plan now. Let's line things up now before, you know, the rates go up and the qualification gets tougher with some of these lenders. And this is my dog barking, agreeing to what I'm saying here. Okay, future refinances, big one, especially for commercial investors, okay? As I showed you earlier, the bond yield is going up. Commercial financing is priced based on the bond yield. A lot of commercial lenders rely on the bond yield. I think, Harry, you mentioned the example earlier. When you submitted your application, the rate was at what?
When I submitted, for BMO, it was just scratching 3%.
And when the deal closed, what was the rate?
4.79.
Okay. So in the commercial world, the lenders do not lock, a lot of lenders do not lock the rate for 120 days. They lock in closer to closing. Some of them lock in.
They don't even lock it for 120 seconds, Dahlia.
Oh, in your case, they didn't lock it. Okay, so that's an extreme case scenario. So here's what happens with commercial financing, folks. When you, let's say you're working on a project and you're going to improve the condition of the building, and you know you're going to refinance the property at a higher value with higher incomes somewhere in 2022 or maybe 2023, in the midst of the rates going up. We want to make sure that today we account for these rate increases in helping you determine what your exit mortgage is going to look like. Because if we don't, you will get a higher rate when the time comes. Not only that, but it will eat into the loan amount that you planned for. So you may end up with less money, because with commercial financing, the rates impact how much the property qualifies for in terms of a mortgage. So it's so important stepping into this next phase to give ourselves a buffer when it comes to mortgage rates and see how it impacts the numbers that we had initially planned for, so that there are no surprises. You don't want to be in a situation where you are walking away with, $100,000 less than you expected. You cannot pay your investor. Of course, we're going to figure out solutions. Nothing doesn't have a solution, but if we can plan better, it will save you money. and it will save you frustration, and it will put you in a better position. So that is a big one, future refinances. Okay, values. There is talk about the market softening, and of course there is gazillion sources saying, oh, this is what's going to happen to values. It's going to crash. It's the bubble, and the bubble is going to burst. Again, nobody has a crystal ball. Is there a concern about values? Maybe, but here are my thoughts. Here's my thoughts based on what I've observed. 2018, when the regulators introduced the stress test to basically fictitiously test the strength of a mortgage applicant in case the rates rise. So it's actually good that they did that, because now that the rates are rising, there is comfort that many people will be able to afford their payments because they qualified back in 2018 onward at a much higher standard. My point is, when that came into effect, okay, it did slow down certain areas of the market. Real estate is not one big market. It's not all brushed with the same brush. Every market is different. Every property type is different. But here is what we observed on the mortgage side. We observed that the properties that were higher end, like a Toronto market, okay, the properties that were higher end, above $1 million, are the properties that experienced softening in values. We didn't see it in the properties that I call mass market product. Why? Because when the rates go up, people don't buy properties, people buy payments. So if I had initially planned to buy $1.5 million home at a 2% interest rate, when that rate rises to 3.5%, now my monthly payment is significantly higher. I can either afford it, or I can say, you know what, now I have to go to the next category down to make sure that this payment is within my budget. So people buy payment, not the property. And when the interest rates go up, there are certain areas that will be impacted. I believe, based on what we've seen in 2018, is that the impact will be bigger on properties above the $1 million because they are less affordable. Rental properties, I think the demand will still be significant because now you've got the investors, but you also got the people who want to get into a housing, and we know that we have a housing issue here, are going to look at cheaper properties. Okay, so this really means that there may be opportunities for investors to buy, at better terms. There may be opportunities to compete better. Okay, but here are the key points on this particular point with respect to value. Financing conditions are going to become important going forward. In 2018, for those who didn't plan well, here is what I've seen happen. Someone is buying a property and going firm on an offer, and selling a property, and then they're buying another one and they're going firm on this offer, and their closing was caught in this market decline on a higher end property. This was in Toronto. What happened? What happened is the values didn't come through. The value for the purchase didn't come. The value, they thought they're going to sell their house for this much. The person that bought the house could not get an appraisal for the full price they paid, and they couldn't get an appraisal for the full price they paid on the house they purchased. So what happens? They became short on money as a result, and they had to scramble to find that extra money. And this is one risk that we need to be aware of as investors. In the past year and since COVID, firm offers, competitive offers, multi-offers, let me just get this property and I'll worry about appraisal later. No, you can't do that when we're going into this cycle. I highly suggest that we do appraisals as early as possible. You don't go firm on your offers. I know the market is competitive, But if you can put in an appraisal condition, don't call it financing, call it an appraisal condition, okay? At least we can validate the value. So you're not stuck with shortage of money and then having to raise money or get bridge financing that is expensive. It's better to go in with the understanding that values may not come through in certain markets, and better be safe than sorry. This is my quote for closing. Luck favors the prepared mind. And also, Warren Buffett's quote, be fearful when others are greedy, and greedy only when others are fearful. And the rising tides raise all boats. So if you look at the stock market during a declining period, folks, to draw a parallel, I think we learn a few things. Number one, we know that skilled investors make money in all market conditions if they're skilled. In fact, Warren Buffett's famous quote here, be fearful when others are greedy, and greedy when others are fearful. We know that in a downturn, there is usually a flight to value, okay? And what you buy will matter. So it doesn't matter whether the market is going up or down. What matters is, will your property cash flow? Have you planned for the worst case scenario in an uncertain market? All right. And yeah, rising tides raise all boats, but what happens when the tides are gone? That's the third lesson in my view that becomes obvious. Skill in investing is going to be crucial going into this period that we're going into. So getting advice from the right people who have the track record, master the skill of investing. Harry talked about this property that sold for less weeks after. I live here in Woodbridge. The house on the street sold for 1.8 million. 3 months later, nothing was done to the house, sold for 2 million. That's not investing. That is just speculation. So going into this period, honing on your skills of investing, doing your diligence, planning, using methods and systems to help you hedge is going to make all the difference in my view. And we have developed a couple of tools to help you plan things out. So we do give away this rate scenario calculator as complimentary to clients, and we can help you stress test your portfolio. We do complimentary planning sessions to help you map out what financing would look like for the next 2, 3, 4 properties. If you have properties in the works and you know you're going to exit, a renovation, let's say, in an uncertain time, we can help you hedge and plan what that would look like from a mortgage standpoint. And we have a multifamily loan calculator. So if you're in the multifamily space and you are trying to determine roughly what loan amount would the property qualify for in case the interest rates rise, this calculator would also help you.
Awesome. Thank you so much. So so they basically email you at info@streetwisemortgages.com, and then they get access to the tools, correct?
That's right. Yes.
Okay. Amazing. I mean, these are great tools. Let's plan ahead. That was great insight, Dalia. Lots, I think a lot of questions were actually answered as you were going through the content. And look, it is going to be interesting. I think this is an opportunity for investors that have been investing versus speculating to actually do very well. So, I'm excited. I'm excited for new opportunities. I'm finally not competing with 20 plus people at once. I think there's a great opportunity. So we're going to open it up to questions for Dalia and Harry. And before we do that, though, if you haven't received or got your ticket for the all-inclusive 3-day retreat at Inspire Beach Resort, have your cake and eat it too. It is going to be for real estate investors, for entrepreneurs. We're going to have everything all inclusive, great content, workshops by Harry, myself, other great speakers as well. You know, again, we're capping it. So yeah, there's a few tickets left. I put the information on the chat. So if you are interested in getting a ticket, it is going to be absolutely completely different than every other retreat that you've heard of. Harry, anything that you want to add about the retreat?
Well, I think the most important thing for me is we're not bringing you there to sell you anything. We're really just trying to create an environment that will inspire and help you crystallize whatever it is you're trying to achieve. So I know a lot of times you go to these types of things and there's a hidden agenda to sell you something or get you involved and follow up this or follow up that. This is just a celebration of like-minded people that are trying to make a difference and try to make things happen. Even if you look at the pricing, $2,000 for 3 days. It includes all transfers, meals, entertainment, and everything. I think we'd all agree that's certainly not you know, something that we're looking to make a lot of money at. So it's going to be I think just a great vibe. You can't manufacture chemistry, but when you have the right people together, some magical things happen. So that's kind of what we're looking for.
Amazing. Awesome. All right. So we're going to open it up to some questions for Harry and Dahlia. And again, the retreat info is in the chat. So I think we have a question here so for Dahlia from Jurgo Biro. Sorry, maybe it's girl. Anyways, sorry about mispronouncing the name, but when do you estimate that variable rates will come close to 5.25 for the benchmark rate? Oh, Dahlia, you are muted.
I was just reading this question as before Sarah read it, and right now the variable rates are around 2.7, 2.8. If there is another 1% increase coming in 2022, we are at 3.7. Another 75 coming in 2023, we're at 4.45. So we're still below the benchmark. This is what I was trying to explain earlier. If you are applying for a fixed rate today and it's at 4%, right? The lenders are adding 2% to it, that's 6%, then they're qualifying you higher than the 5.25. But if you're applying for a variable rate, you're still fine. There is quite a bit of, like, there is a runway, a long runway. And even if I add in the anticipated increases, it's not going to hit the benchmark at the 5.25. But with the B lenders, or if you're borderline qualification with an A lender, you're going to have to we're going to have to see the impact on the loan amount, because with the B lenders, they will take their rate, which is at 5%, and add the 2 to it, which takes you above the qualification already.
Okay. All right. Thank you for explaining that. And there was another question about, you know, is it okay to have more than one mortgage broker, or should they just be working with one mortgage broker?
Sarah, you may want to, we talked about this one in particular in one of the interviews. Do you want to comment on that one?
Yeah, I mean, look, here's the thing is that, like, for me anyways, it's just easier to have one mortgage broker be able to help you with your goals and everything like that. But there's nothing wrong with having a second option. You just want to make sure that you are very, very, very transparent with the brokers so that they know, and you probably don't want to be doing one deal with 2 brokers, right? And so Dahlia, I'm going to throw it back over to you, but that's essentially like my thoughts about it is, you know, yes, I've worked with another broker in the past, you know, but it's not going to be ever on the same deal. You don't want 2 people working on the same thing. It'll look bad for the lender as well, and they'll start questioning. But feel free to add something if you want.
Yes, so to Sarah's point, you want to be transparent about where you're taking your deal. If you're talking to another broker, you want to be transparent with the brokers, because here's what happens behind the scene. If the same deal goes to the lender through 2 different brokers, it does impact the credibility of the deal. At the end of the day, the information is the information, but the way the deal is packaged and presented is where the art of mortgage brokering comes through. So if I have a way of presenting and packaging your deal, and your deal comes through another broker presented differently, and it's sitting at the same lender's desk, it's going to dilute the packaging and will actually harm your deal. So this is why I don't suggest you take a deal through 2 brokers and have them both work on it and shop it that way. select either a broker to build a relationship with, but if you're not happy with their offering and you want a second opinion, you can, but be transparent to both brokers, because at the end of the day, it's your deal and it's not good to receive it from two different channels at the lender's desk.
Okay. All right. Awesome. Harry, question for you. From like your standpoint, like what are you in types of deals, like what are you excited about these days, and what types of deals are you, maybe saying, let's just hang tight on those ones until, there is a little bit more certainty in the market?
Well, for us, we are, I guess, what you would refer to as value investors. So I guess as real estate junkies, and probably all of us on the line today are real estate junkies. If I see something that I think is worth $1 and I can buy it for 50 cents or 60 cents, or I see a change of use, or I see a really ugly duckling that I think we can bring back to life, that's kind of the game for me. I know this sounds a little weird, but the money is almost a byproduct of some of the things that we do. Like, we're proud of some of the things we've contributed to the landscape. We love creating beautiful places where people can live and enjoy their families and enjoy their journey. So I know it sounds a little airy-fairy, but it's the reality. So the things that we're excited about the resort. You kind of quarterback that, but to create a space with beautiful cabins, with hot tubs and barbecues where people can connect and enjoy life and recognize what's important in life, and to bring that to the landscape on a dilapidated 30-year-old resort and bring that back to life is exciting. It's motivating. And kind of, as I said, I think when you're doing things for the right reasons and money is a byproduct, you look at deals differently. And I think that's what we do in our company. So with respect to the current environment, we're conservative. We're not big leverage people. We want to make sure that we can finish. We want to make sure we have some breathing space and some margin, and we want to make sure that we can underpromise and overdeliver on what we've already committed to in terms of our purchasers. So our frustration has been the COVID excuse for incompetence and people sitting in their underwear in their basement, not returning phone calls and emails. So we're behind a year and a half in some of our projects, and that costs us money, and it's frustrating for the people that are waiting for the product. But again, it's all part of the game. You just keep stick handling through and keep doing little things to keep the ball moving down the field. So you know what, it's kind of, I know I'm going on and on here, but I said this at the beginning. It's too early, and I know Dahlia mentioned this too. It's too early to assume anything. It's too early to assume there's going to be a correction or a this or a that. If you stick to your criteria, stick to your journey, and stick to what it is you're trying to achieve, and just make little adjustments along the way, I think you'll have a much more relaxed mindset.
Yeah, absolutely. Well said. Thank you for that. Dahlia, anything that you would like to add from, you are also an investor, which is great, but just from what you're seeing come through on your desk in terms of deals that like still maybe make sense, or some maybe regions that still make sense where they're like, okay, this is a good deal. And maybe some that you're seeing that like, you're like, you know what, this could be a little bit iffy for the next 2 years.
Well, what we're seeing, we're still seeing multiple offers, but we're not seeing crazy competitive market, multiple offers like it was a few months ago. So the extent of multiple offers have gone down. We're seeing some financing conditions back into offers, which is great. I worry a little about right now, again, given what I've seen in 2018 when the stress test came in. I am concerned about investors who are buying the highest value property on a street, because when the market is rising and you have a highest value property on the street, the appraisers can still justify because the market is rising. But if the market is going to soften and they bought the highest value property, the appraisers are going to start to look trickier. And that's something that we are warning investors about. We're saying, you know what, show us the MLS listing. Is this the highest value property? And if so, can we get an opinion early on from our appraisers now before you actually lock in an offer, so that we can get the appraisal done quickly? Because I feel that we are in this transitionary period. So that's the only thing that I'm a little concerned about right now.
I mean, it almost goes back to even what Harry, you were saying about like value, right? I mean, you don't want to be buying the highest thing that's all, done, already finished, and just hope that you are going to keep banking on appreciation. But what needs work? What is an opportunity? I mean, we bought a few completely gutted properties that have a great, ARV value, but it's also, some of the cheaper ones because of the situation that what they look like. So I think there's still some opportunity, like you said, with value. What about like pre-construction? I know I'm seeing some questions here about pre-con. Again, this is just my opinion, but if you're expecting to assign, I always like worry a little bit about that. If you're closing with no cash flow, again, I worry a little bit about that. If you're closing with cash flow, that's a different story. But Harry, Dahlia, like, what are your thoughts about like, buying pre-construction right now on the expectation that you're going to be assigning and not potentially closing, or maybe closing but not cash flowing?
Well, I have a pretty strong opinion on that, and it may offend some people, and I apologize if it does, but I had somebody, my daughter was looking for a condo in downtown Toronto, and they called me. Actually, I think I mentioned this to Dahlia. They called me about 6 months ago because for some reason, I had my name on it. And they said, yeah, there's this building. At that time, it was 1,500 a square foot. It was like 1,000 a square foot 2 days earlier. 1,500 a square foot, great deal, blah, blah, blah. And I said, well, we got to be careful. I'm not sure in terms of affordability and her income and so on. He says, oh, don't worry about it. He said, what? All you have to do is within 6-9 months, if you want, we'll sell the paper and we can make you $100,000, $200,000. Now, that person should have lost their license, in my opinion. That is not investing. That's actually getting people in trouble. If you're buying anything, if you can't close it, I don't think you should buy it, because you're literally at the roulette table putting your number, putting your money down on a number. I think you always have to have the ability to commit and close on what you've done. If you are in a rising market, and there's nothing wrong, I guess, with buying low and selling high, and you're able to get that, sell the paper for 100, 150 grand, if that's your gig, I guess that's fine. But to actually have that as your complete 1,000% mindset, and you don't have the ability to close, that's like bungee jumping without a cord. I'm not sure I'd be doing that, because it won't end well.
Right. Okay. So here's an example. So Art, not saying that that's what he's doing or not, but he has a tentative occupancy date on a pre-construction condo, July 2023. When should he start looking for a mortgage? He is going to close and rent it out, and bought it in 2019. Thoughts on that?
Okay, so because value, I am a little concerned about value in select markets. I would suggest that on a new construction, to get a firm mortgage approval now. To get that firm mortgage approval from either the builder the lender that is on the builder side, and they are the ones who would do that, or to go to a lender like RBC. They do firm approvals on new construction. Firm approval means that regardless of when the time comes when this condo is registered in 2 or 3 years out, if you lose your job, God forbid, or something happens, or value doesn't come through at the time, a firm approval is a firm approval is a firm approval. So hedge by doing it now. Don't wait 120 days before closing.
Absolutely. And there are only certain lenders or certain banks, right, that you can do a firm.
Certain banks, not all banks would do this. This is why I'm suggesting they either go to see if they qualify with RBC. That's a product feature. Or they talk to the lender that is at the builder site and ask them if they're going to do a firm approval today.
Nice. Yeah, absolutely. Okay.
And then there is something with respect to hedging that I wanted to just mention to everyone quickly that I didn't touch on in my presentation. When COVID hit and panic and fear were the theme for quite some time, and people were concerned about jobs and liquidity and all of that, there was a rush to set up secured line of credits, and we could not set them up fast enough, and in some cases people actually lost their jobs before qualifying, unfortunately. So again, back to the point about planning, this is the time to plan. If the talk about values is true and recession or whatever, it doesn't matter what the extent is, the point is there will be opportunities, and you want to be able to jump on these opportunities. And if with that mindset, set up money today, in my view, using secured line of credit, so you have it in your back pocket. Don't set up the money when you need it, when you're desperate for it. Okay, so I just wanted to mention that to everyone.
Okay, perfect. And so just for the purpose of time, it is 1:20. So we're gonna wrap it up here. But you know, the contact information is on the chat for both Dahlia and Harry. I'll put it there again as well if you have any additional questions. And then obviously the retreat, feel free to come out for that and get your ticket. But Harry, Dahlia, I mean, this was very informative. I like to do these webinars because you know, when I do webinars, as much as possible, it's content, it's value, it's you know, bringing in the guests that we can talk about the topics that are pertinent and relevant and all the things that are top of our minds. So this will be available for those of you that turned up. We will send an email for exactly where to get it. And Harry, Dahlia, thank you guys so much for your time today. It was really informative. Really appreciate you know, giving back to my audience and helping them maneuver through the next few years.
It's a pleasure. Thank you for having us.
Thank
Awesome.
you.
Thanks very much. Bye, everyone. Thanks for tuning in. Thanks for your time.
Bye.